Hello, friends. Welcome to Nirmal. I am Piyush Jain, and today we are back with another corporate conversation. Few days back, we interacted with another real estate company where we talked about the entire pan India market. And if you remember, we also discussed, we also brought you another show where we brought a real estate specialist again, and we discussed about how the entire situation is happening in India. Today, in the same series, we are now actually bringing to you a corporate which is specialized, which is very well known. The group doesn't need any introduction. They operate very strongly in the southern market, and of late, the numbers have been stellar. The revenues have grown more than 50%. And before I give you more details, let me welcome the management on the show, Mr. Gopal Krishnan J, the group CFO and ED of Shriram Properties Limited. Sir, welcome to the show.
Good morning. Thank you.
Now,
Thank you for inviting me. I'm happy to be here.
Yes, sir. So Shriram Group is very well known, very well penetrated across many verticals. On the Shriram properties, dear viewers, let me actually give you a snapshot before actually we start our discussion with sir. Revenue in the last quarter has grown very strongly, more than 50%, in fact 60% up YY. If we talk about EBITDA margins, again, strong EBITDA margins, a bit of base effect, but very strong EBITDA margins. We have also seen reduction in interest costs. We have seen very strong growth in net profit versus the last year, versus the last quarter. Both the sales volume, sales value have grown very strongly. It looks like the company is having some very strong times and also is actually seeing a lot of project moving towards completion and also very strong project pipeline. So for all of us, the real question is what is really working well for the company and what we should be expecting in the future. So let's now go to Mr. Gopal Krishnan with the first question. Sir, if I look at the numbers, revenue, profit, EBITDA, all have grown very strongly. So Bangalore, Chennai, Kolkata, or Hyderabad again, any of these markets where you are present across, what's really working well right now?
Yeah, thanks for highlighting all the numbers. Let me try and approach this question in a different way. So it's there are a combination of factors that are working well for branded real estate players. If I approach this from where it is all coming, post RERA in 2017 when the RERA came in, the industry has started moving towards larger branded players. That's the theme which is going on. So the opportunity is large. Opportunity is available for all of us in the branded space. And therefore, I think the industry is moving towards top 7, top 10 people becoming like accounting for about 80% of the market. So that's the kind of consolidation which is going on. From a 25-30% market share of the top 10 players, I think now we are at about 60-65%. So there's a meaningful transition towards a branded, more organized real estate market which is happening around. That's the biggest trigger for us. For Shriram, the added advantage is we had thought about this whole consolidation, the likely benefit, and we were one of the relatively smaller players pre-RERA. We were selling about 1 million square feet a year. Today we are selling close to or more than 4 million square feet a year. And the thought process was that the RERA came and said we have to prepare this organization for a 5 million square feet organization every year. Therefore, all the effort that we took to build the manpower, bandwidth, the capability to sell, not just sell, but also sell, execute, hand over, collect, construct, and hand over to customers. The entire organizational bandwidth got built up, and we are now able to reap the benefit of it. Post RERA, if I look at, we were 0.7 million square feet around when the RERA came in, annual sales volume. We literally doubled our volume for the first 3-4 years. And then we are consolidating ourselves with a 3 to 3.5 million square feet over the last 2 years. I think this year we should be ending with excess of 4 million square feet. So that consolidation and the combined preparedness to take benefit out of the consolidation is the one which has actually worked in favor of Shriram. For the last 8 quarters, we have been consistently delivering more than 1 million a quarter. That's about roughly a good run rate that we have managed to scale up. So the whole ramp up has happened. That ramp up impact is showing up on the P&L now. As you know, real estate is all expenses today, all the income is 3 years later. Right? That is the nature of business because of AS 115. which was made compulsory for real estate as well, whereas real estate was treated differently in the past, in the earlier regime, with a percentage of completion method where you could recognize income. Now they have said only when you complete all obligations to the customers, you can recognize income. And therefore, what we do is, what we sell today, we are able to recognize income only after 2 3 years. That's what is showing up now. In fact, my ramp up has to, my organizational ramp up that I did over the last couple of years is beginning to show up now. It should gain momentum in the coming years as well. So that's the force behind our improving numbers in our view. What I call that as an operating leverage. From the organization was operating at a 4 million square foot capability in terms of cost and bandwidth, was recognizing income for only 1 million square feet every year, which was the historical run rate. Today we have moved to recognizing 2 million square feet of sales income, and therefore the profitability and revenues, everything look more meaningful and make more growth. This is exactly consistent with what we have promised to investors during the IPO process.
Right, sir. I also want to ask you regarding the business model at present, between the own developments and the joint ventures and the commercial aspects. How's the company progressing towards managing the scale of growth we are aiming for?
Yeah, actually, we have traditionally been a partnership model, and we have over the last 20 years mastered the art of managing partners, and I think that is paying off well, because in a consolidating environment, smaller players are looking for big boys to handhold them, and in that context, one looks at it. It's therefore beneficial to have that positive goodwill or a positive brand equity in terms of ability to work with partners. The trust, transparency, and governance has been our mantra, and that's the Shriram Group ethos that we follow religiously and rigorously here. And that has actually been a big winning game for us. The partners come back with repeated, what I call as repeat orders. Partners come back with the new land parcels again and again to say that can we do together, because they feel that comfort. It's transparent, there is an aligned approach, and therefore they think that they are better unlocking their value from land bank with us. That's the biggest benefit that we are having. More important, if I look at currently, about 15-16% of our portfolio is owned, which is primarily the land bank driven. We are adding more JDAs in the recent years. So JDA and our own together should be about 30% of our overall portfolio, and DM would be about 30% of the portfolio, and JVs and JDAs would be about 35% of the portfolio. DM would be 35%, and that should be our own. And we think this ratio will continue. We think DM will continue to be a growth engine for us. JDAs have been a tested model in the real estate sector, and will continue to do that. Our own development, in fact, we do see Bengal as the only land parcel that we have. We are now in the process of acquiring some small land. See, we don't do land banking. Let me clarify that. We don't do land banking. We primarily, if at all we acquire land, we acquire project-related land, apply for approvals, launch them. So basically, it's a raw material that we are picking up for launching our project, than trying to buy 100 acres, 200 acres of land parcels. The only land exception to the strategy has been Bengal, where we acquired a very large land parcel where the process monitored. So coming back to the question on partnership model, or on the various models, I think DM will be a primary focus. JVs, JDA will continue to remain in the framework. Own development will be a very small share of overall development share going forward.
Okay, so that's a very good clarity on the business model. Let's also talk about projects. I'll go into financials at the end of the discussion, but into the projects across Bangalore to other territories, it appears we have seen some very good price movement across a couple of projects. Those could be Park 63, again, strong improvement there. We have also seen good price improvement in the Southeast Phase 2, but from different projects, sir, give us a sort of some clarity on what we should be expecting as we move ahead. Which other projects you think actually are now going to move towards cash flow realization over the next 2-3 quarters?
Yeah, actually, we have 2 3 projects. One is Park 63, which is primarily the land bank. Second is Park 64, which is primarily the joint venture. Yeah, actually, if you look at, we have overall pipeline is about 51 million square feet, even 52 million square feet, of which 21 million square feet is ongoing. Rest is upcoming projects. And out of the 21, maybe about 18, 19 are our own, rest is land ownership. Nearly 90% of this volume has been sold already. Those projects are in different stages of implementation. We think they will get unlocked from a cash flow perspective, they'll get unlocked over the next 2 years. So we're expecting about 300 to 350 crores of cash coming back from ongoing projects for the next 24, 30 months.
Okay, that's roughly 7 to 8 quarters. Now, if I talk about the projects which were launched in the last 3 to 4 quarters, like one was Park 63 2B, where we have already seen 20% inventory being sold. We have also seen Shriram Golden Acres, again 30 to 35% inventory being sold, and then Eden 144, which was launched last year, again almost 80% sold. Are these projects where you are expecting that the cash flows will keep coming, and are they something where they will influence the margins in the next 2 3 quarters?
So the turnaround time for these some of the apartment projects would be about 2.5, 3 years. They don't come up just like that. Plotted the turnaround time maybe a year or so, or less than a year. So plotted development that we have launched in FY 21, 22, 22, 23, they all deliver cash flows in 23 and 24. Apartments would take, it will come in phases. That's why I said each project wise, yes, I'm happy to go through each project, but they may not really add up meaningfully in people's mind when they listen to. And unless you see the Excel sheet, that's why I'm trying to give you a broader perspective. Out of 19 million square feet, I think we will complete about 10 million square feet over the next 2 years. Between FY 24, 23 and 25, we will complete about 10, 11 million square feet. FY 23 would have recognized about 2.5 million square feet. So that leaves you with about 7.5 million square feet to be delivered, 7.5 million square feet to be delivered over the next couple of years.
Okay.
And these deliveries is what is actually going to bring you cash flows, and that is the cash flow that I said between 300 to 350 crores of cash flow coming from project completion. So will it come from Bangalore? Will it come from Park 63? It's an interesting question, but not sure whether without an Excel sheet in front of you, the listener who listen will be able to appreciate it. If I say, oh yeah, Park 63 between 1 year, 1 year, 2 year, 2 year will generate 300 crores, doesn't really go in people's mind. That's why I'm trying to take a broader picture. What would be important from our perspective, from Shriram's perspective as an internal system, we are keeping an eye on execution of these projects. The timely completion and execution, timely completion of these projects will be key to unlocking not just the cash flow but also from a revenue recognition perspective. We have always consistently maintained that the cumulative period, FY 23 to 25, I look at my P&L, nearly 75% of the P&L is coming from volume sold as of March 22, right? And that can happen only when you focus on execution. Today, I don't see any projects in our 15-16 project execution ongoing portfolio. Any of them are far behind the RERA timeline. So we are executing projects within the RERA committed timeline or customer committed timeline, and therefore we believe we should be able to complete them over the next 6 to 8 quarters, and that should actually help us in not only recognizing revenue but also unlock cash flow. From a revenue recognition perspective, just want to highlight, as I said, 10 million square feet is what we want to complete and deliver between FY 23 to 25. 10 million square feet average of selling price of, like on average 3 years, if you take about 3.5 million square feet is a normative. I'm not talking about any particular year. On a 3-year period, average or normative delivery would be about 3 to 3.5 million square feet. 3 million square feet at a 5,000 rupees square feet per square foot basically means 1,500 crores of revenue recognition. Mid-20s EBITDA margin, 10%, 11%, 12% PBT margin. Therefore, gives you a broad outlook of where this company's P&L is headed between FY 23 and 25.
Right, sir. Just sort of going back to your last numbers here. So we actually are talking about almost 350 crores of sales happening between FY23 and FY25. Would that be a good assumption?
350 crores of sales? No, it has to be more than that.
Okay.
There are two aspects here, right? One is the sales and sales value. That what in some people in the industry call pre-sales, which is really what you are selling this year, and there is sales value associated with the KPI that we monitor. Second is the income recognition. What I mentioned to you 1 minute ago was the income recognition numbers, 1,500 crore roughly our income recognition.
Okay.
Sales at a 4 million square FY 22-23. If I close, I'm just ballpark taking between 4 and 4.5 million square feet. Let's say 4 million square feet means 2,000 crores of sales value.
Yeah. And
Not
what's
50.
what's the average realization per square feet you would be expecting between FY23 and 25?
So as a company as a whole, it's the blended average, because between blended average between mid-market, affordable and plots. And if I look at only at plots, I'm around 6,000 rupees a square feet. On the affordable mid-market product, I'm around 6,000 rupees a square feet. Affordable housing, I'm around 4,300, 4,400 rupees per square feet. Plots can be anywhere between 1,800 to 2,500 rupees, depending on the micro market. So,
Okay.
and we blend all of this. Sometimes, in fact, many analysts ask me this question: why your average realization is 5,500 rupees, whereas Shobha, Brigade, Prestige, like they put the publicly listed peer group numbers. I keep highlighting to them that it's about the basket. If Shobha has 75% of premium luxury in their basket, their weighted average number will be higher. Whereas I have 75-85% is between mid-market and affordable, and therefore my weighted average will be different. The right way to compare would be, can we compare peer groups? Most of them disclose these days. Peer group averages between mid-market and affordable, what is the pricing? Affordable may not be there, but mid-market I am around 6,000 rupees, Shobha must be around 7,000 rupees. So there is still a price gap that I need to catch up. But I have come up, as a Shriram, we have come up a long way. We used to sell below 5,000 rupees 3 years ago. Average.
Okay.
So we kind of gradually moved up the pricing curve. And I was hoping you'll ask me a question, but I'll still answer that question about the price trend in recent months. But we have actually moved up the price curve as a portfolio through upgrading the product spec or by upgrading the micro market. We have actually managed to come to where we used to be about 5,170 3 years ago. From there to about 6,000 rupees is a meaningful jump. So the point I'm trying to drive at is, we are trying to use all the levers possible to unlock value from this company. We have moved up the price curve consciously. We have scaled up the operating dynamics, which is basically we have ramped up quite nicely over the last 3 years. We have increased our turnaround, improved our efficiency and reduced the turnaround timeline, so we are able to deliver projects faster. And therefore, we are targeting to deliver 10 million square feet in the next 2 years, 24, 30 months. So all of this actually collectively coming to unleash or unlock the potential value in this whole organization. That's all we are trying to do.
Right, sir. And by actually bridging the sort of price gap, are you expecting sort of further sort of decrease in the price gap as we move along over the next 2-3 years?
I'm sure all of us are expecting, right? The peers are also expecting to move the price curve. So I really find it difficult to say when we will bridge this gap. I don't know. But the aspiration would be to bridge that gap to a more meaningful level, as we believe, because I think we still have potential. From an upgradation perspective, I just want to say, combination of our own efforts and the market improvements, we have actually moved up about 15% in the last 18 months. October 21 is when the price movement started. We saw the strong market undercurrent and therefore started moving into the price curve. We have increased between 0% to 16-17% last fiscal second half. So, about average portfolio level 8% increase in selling price in second half FY22. FY23 for the first 9 months we have gone up by 9% at the portfolio level. So, as a portfolio level we have gone up 15%. Some part of that will get shaved off by the interim spike in cost that we witnessed during Q1 fiscal 23. and it's of course they are all moderated now. Though they are above pre-COVID levels, but they are moderated significantly if steel or cement or RMC and so on and so forth. So
Yes.
some part of the price increase has gone into offsetting the escalation, cost escalation, but otherwise it will go up and it will support the margin enhancement as this project is implemented.
Right. So in the southern markets, mainly typically in Bangalore and Chennai, what's the sort of recent trend in the fourth quarter is looking for you on the raw material prices?
On the what prices? Raw
Cement,
material.
yeah,
Raw material prices are very stable. I think it is most of media creation, most of the time they keep, I think, looking for every ticker in the LME and BSE exchanges to see what the cement price is doing and what the steel price is doing. At the grassroots level, because I have been consistent even in that time in the earnings call I mentioned in the past that 82,000 rupees steel and all is not going to stay. It's all short-term spike. Like any commodity will go through the cycle. They all come back. Now they are around 68 to 72, 68 to 69 to 72 compared to a pre-COVID levels of around 56, 57. So they are higher from pre-COVID levels, but they have not really stated that the spike that we saw in Q1 FY23 or early part of this fiscal. All moderated meaningfully. Cement and RMC, I'm sure you all know the cement prices for across regions. So they also moderated well. So this spikes will keep happening. Where I see is, in fact, in one of the earnings call, I did clarify this number. With all the spike that we saw at the peak of 82,000 rupees steel per ton, and I think cement was about 500 odd rupees per bag, right? I think it was in Q1 this year. We did see we did map because the impact is not same across all projects. The life cycle of the implementation is 3 years. The spike when it happens, which are the projects that are the early stage will be impacted by cement and steel price. The projects at an advanced stage will get impacted by the change in imported sanitary ware, the competition from China, competition from other markets. So the cycle where the project is, the cycle will determine how much impact is there. I think April, May, June, we estimated this with whatever the prevailing commodity price at that point of time. The net impact to us was about 350 rupees per square, 360 or 350 rupees per square. Today, pre-COVID to today's price, if I take, maybe the impact would be about 200 odd rupees per square feet. So it depends on where most of your projects are in the cycle. And even at 350, it basically means about 8% price hike. Right, it would cover your costs, cover your margins. So therefore, we have not been, and I remain that confident that we are not that unduly worried about commodity price as yet. Commodity price eating away your margins, because I think the pricing profile has also improved. Therefore, it's kind of helping us offset all that. Margin will be protected. In our case, because of the operating leverage, the scale economics, margin should see a rising curve.
Okay, sir. And help us also understand from the perspective of the new tie-ups which you have gone through. The example could be ASK, and there are more. So, what is the strategy behind that? How it is working for you, and what is the sort of plan in the future?
Yeah. So the ASK platform is a co-investment platform where we share cash flows from the project as a partners. Right, and there can be platforms or partnerships which are revenue sharing. We opted for the cash flow sharing because they share the project risk profile, and therefore it becomes a equity or equity-like partnership. We don't want to get into a debt-like partnership. So this platform has taken off well. We put the first project called Shriram Pristine Estates, which is a stressed asset we acquired from one of the lenders, and we think we've got a sweet deal. We launched the project. It's done extremely well beyond our expectation, and I think the platform therefore has taken off well. This platform is basically shares cash flows from the project in a waterfall mechanism where At one point of time, ASK will have a priority. Then second stage is what for Shriram will have the priority, and then both of us are on par. Once we reach that first two priorities, we are on par. As long as the other partner gets 20% IRR and then they are out, the rest of the cash flow belongs to us. So any project which has more than 20% IRR, if I dump it into this platform, I have to get a disproportionately higher IRR because my capital exposure is 20%, whereas I get proportionate share of cash flows as well as my DM fee, as well as any return in excess of 20% belongs to me completely. So therefore, a project which has more than 20% IRR, and typically we don't touch any project below that number, and therefore that should be value accretive for the capital that I invest. My return should be materially higher than ASK rate.
Right. Sounds interesting and profitable also. From that perspective, like how much has been the investment? If you can share that, and any further plans about any other project, any major quantum which is getting committed?
Yeah. So this is a 500 crore platform. 100 crore to come from Shriram, 400 crore to come from ASK. And we have, out of the 500, we have consummated only one project, which is committed capital of over 120, but we have used 70 to 80 crores now. And I think we will remain with whatever we have committed, with whatever we have invested, because the project has taken off well. So it doesn't need extra capital. So around 85 crore is the total consummation out of the 500 crore platform. We are already working on two large projects, and they should actually consume a large capital base. But we will wait for the partners to agree, align on the, because every project has to be presented to the partnership, and the partnership has to agree to accept that project on the platform. Otherwise, it can be Shriram's own project separately. So we have presented a couple of projects. We are working with the partners and hopeful of consummating at least one, preferably two projects in the next 2 months.
Okay, sounds good. And from that aspect, sir, I've also observed that you have been able to consistently reduce your debt. Interest expenses have gone down, and that has also shown like the shift to the banking also again has shown there. But when I was looking at that development and I was looking at this ASK and more partners development, it is also opening a possibility that you might be less capital intensive because you're getting equity participation from your partners, and that perhaps could also play a part in sort of further lowering the interest burden and maybe improving the PBT also. How much sort of that impact could really flow into P&L?
So it's not a replacement. It's a growth capital. Because currently what I have is about 400 crores of net debt and 500 crores of gross debt, and I have like 14, 15 ongoing projects. So on average, I'm sure some projects don't have a construction finance need, some projects have more. But on average, it's about 30, 40, 50 crores of capital per ongoing project. So that much of construction financing will always be there. So I don't see ASK platform reducing the net debt. Our net debt strategy, net debt zero or net debt negative, net debt positive strategy, right? That we have been trying to push through. We're committed that will be zero net debt, hopefully by FY24 end. That is basically to say, because growth will always need to be found. If I didn't have the ASK platform, you would be compelled to raise capital within our balance sheet and deploy the capital for growth. See, at the end of the day, I am not a manufacturing or I am not a mature business. I constantly need growth capital. And 100% equity funding of any real estate project would be disastrous from a balance sheet perspective. We are deploying equity money into construction finance, which can be. So therefore, there will always be debt in this balance sheet. Just want to clarify. What we are aspiring is to have a net debt zero at least, right? So that much of liquidity, cash surplus is there in the balance sheet and in terms of overall balance sheet. The ASK platform actually help you find the alternative growth capital at an equity mode or a quasi equity mode, and therefore the stress on your balance sheet comes down. Because you don't need to put 100% of the project for acquisition. Like for example, this project which already dropped into ASK platform, the acquisition cost and pre-launch, all the costs put together would be about 85 crores, roughly about 85 crores. If I had to fund on my own, either I would have put my capital, equity capital or the borrowed capital for 85 crores. Because then stress is like acquisition. I cannot put, the lender took a meaningful haircut. That means he is not going to wait for a JDA model or a JV model or a DM model. He will say, if you are buying from me, here is the haircut I am willing to take. And in that kind of context, instead of putting our balance sheet to work, it is better to have a 20% of our balance sheet, 20% of the requirement to go from our capital and the rest is coming from a partner. And that burden is what this platform is reducing the incremental debt burden.
Yes.
Not necessarily going to reduce the existing. Existing debt will have to be reduced by these projects unlocking capital from their own operation. Like as they come to closure, they need to be able to pay back their debt.
Understood, sir. And I'm now summing up our entire discussion with going back to the basic numbers we talked about, and with that, we'll round up our discussion. You actually talked about between FY23 and 25, 10 million square feet is what you're aspiring to be constructed. Will that be the sort of right assumption we'll leave with?
Yeah, I think so.
Okay, sir. So with that and with all the developments, I think this should be a very exciting development for our viewers to really track for. Price range, as you've already talked about, between the various projects, between 1,800 to 2,000 square feet to roughly around 5,000 rupees per square feet. That's the sort of a bracket we are working with. 10 million square feet area is what actually we are aspiring to get constructed. A lot of new avenues from partnership model to a lot of projects. And also basically the pricing environment has been kind enough over the last couple of months for the southern market also.
If I see who am I, right? If I try to discover what this company is all about, I just want to sum up by saying it's a very strong brand, as a very strong market player both in Bangalore, Chennai, and Kolkata, and has a very strong pipeline which can take care of growth aspirations for the next 3-4 years. Already signed up projects that can take care of that growth. Has created a very strong and tested the platform through the COVID and post-COVID. It's a very robust, resilient platform that can sell, execute around 5 million to 6 million square feet a year. With the marginal expansion, it can go up to 7 million square feet a year. That's the kind of operating machine that we have created. We have enough raw material to feed that machine. And the market opportunity is enormous today for mid-market and affordable housing. And notwithstanding ongoing rate hike concerns, I think the underlying demand in the market is very strong, and therefore we see a very large opportunity in front of us in a consolidating environment as one of the top 3, top 4 players in the industry in each of the market. I think we have our game cut out very well, and we are confident of delivering at least 20% CAGR in volumes with an improving margins and ROCE. 2 points I want to make at the end is, if you look at our ROCE, we are among the top 1 or 2 companies, listed players in terms of ROCE in this sector. For the last year, I had my ROCE, we have already improved our ROCE from 3-4% 5 years ago to about 10-11% already. And I think we are very confident and we are on the track to stabilize our ROCE in the mid-teens for the next 1 to 3 years. So we will hopefully emerge as one of the top ROCE companies in the listed real estate space in the foreseeable future. And second, and I am sure you have seen the quarterly numbers. For the 9 months, our EPS is about what? About 3 rupees or thereabout. So an annualized EPS of last trailing 12-month EPS of 4 rupees, and where the stock today is, gives you the upside potential, what I believe the stock presents. I'm not trying to say anything about the valuation or the stock price. That's for the markets to decide. All I'm saying is a very, very strong company showing an impact on the financials already in terms of what shareholder value unlocking is happening. And I think that's what we believe at some stage market will recognize this potential. and give us that value that we believe we have.
Absolutely, and we also hope so. That was a very strong clarity given to our viewers. Sir, thanks a lot for coming on our show and giving us those minute sort of granularity, minute details about the company.
Thank you and appreciate inviting us.
And with that, dear viewers, it's a wrap on this show. We'll continue our conversation over Shriram Properties or the next many shows, hopefully after the next quarter. But for now, it's a wrap.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.